My name is Tara Jensen. I'm the program manager at Loudoun Habitat for Humanity, especially working with our Tools for Life Learning Center. Joining me today is Jeffrey Austinson from Bank of America, and you are out of our Leesburg office. Is that correct?
Yes, absolutely. Awesome. Right off of East Market Street.
Awesome. Well, thank you so much for being here, Jeff. I know this is a really amazing time to be talking about this, and it's very important to have this conversation when there are so many changes going on in our world.
Well, thank you so much, Tara. I greatly appreciate it. And thank you for your partnership between Loudoun Habitat as well as Bank of America. We greatly appreciate the opportunity to get in front of everybody to talk about savings and retirement. As we all know, it's extremely important to plan ahead and save early to put us in a good position to have the type of retirement that we want. Again, my name is Jeffrey Austinson. I am the Financial Center Manager for our Bank of America location here in Leesburg, East End. I've been with Bank of America over 15 years now and had the opportunity to work with several thousand clients to help put them in a position to build their retirement and have the type of retirement they want. And, you know, even especially in pandemics like this or emergency situations, to be in a position where they have a savings strategy in place for those emergency reserves. So jumping into the presentation today, what we're going to be covering, the types and value of savings, strategies to save, step down spending, and impact of compound interest, and finishing with saving for the future. And then we'll go into another component that will put us on track for the retirement piece. So with that being said, we're going to talk about why we need to save. You know, one of the things that really has become apparent as we went into COVID-19 and as this pandemic progressed, and you know, you started seeing on the news people are out of work and unemployment claims are well out of control with over 40 million people out of work. You know, one of the things that I've always tried to help my clients do is save for an emergency. You know, and that number, as far as what we need to have in place in the event of an emergency, is going to vary from one individual to the next, depending on your debt structure, as well as your assets that you have. You know, a bare minimum that you want to have in place is a minimum of 3 months. Right, so as you're going through and you're looking at your monthly expenditures from utility bills, housing payments, groceries, other liabilities that you may have, such as credit cards and auto loans and insurance and medical insurance, you know, as you're calculating that up, you want to have a bare minimum just to continue the way that you are living now, a minimum of 3 months. You know, ideally, you'd like to have a minimum of 6 months in place. Now, again, there's a big difference between the 3 months and the 6 months, right? And a lot of that's going to be determined based off of unemployment and the length of time people are on unemployment. But I would always tell you, as a safe place to be, in a good position to be in, is have an emergency reserve equal to 6 months of your normal monthly expenditures. Anything beyond that 6 months, you really want to be doing something different with the money in a liquid savings account, so your money can continue to grow, right? So the money's going to grow at a different pace in a basic savings account compared to other options. And that's really where you want to sit down and have a robust conversation with a financial expert to help guide you through that piece of your savings and for your retirement. You know, we also have long and short-term goals that you want to save for. So with the long and short-term goals, you know, just to give you a personal example, I have two different goals. So my short-term goal is I want to take my family on a nice vacation. You know, my family is out on the West Coast and my wife's family is out of country. So I want to be able to take my family to both. I want to see my family, and I also want to take a longer trip to go off to Morocco to see my wife's family and introduce my children and, you know, get to know them. But to do that, it's not something I want to just put on my credit card and go. I want to be able to pay for this in cash, so it isn't going to impact my future financial picture. You know, a longer term goal for me is really my retirement. You know, I've been doing this for 15 years, and I would like to be in a position to have the type of retirement that I want to have versus living paycheck to paycheck and relying on Social Security. So that's really where that longer term goals come into place. And everybody's going to be different depending on what your goals and what your life priorities are. I help clients that their long-term goal is to give back to the community and to be more philanthropic. So, everybody's goal is going to be different. And that's one thing that you really have to sort through and have that robust conversation to find out what's important to you. And Tara, if we can go on to the next slide. Perfect, thank you. So one of the things that I always preach to my clients, and I'll tell you a success story after I go over this, but pay yourself first. At the end of the day, you are the one that is working extremely hard to build your savings, to have the life that you want, to pay off all to pay off your monthly expenditures, right? Including your monthly debts, your credit cards, auto loans, insurance, etc. But we always forget to pay ourselves first. When you're planning out your budget, looking at what your monthly expenditures are, you want to put at the forefront you. Because at the end of the day, this is why we work every day. So paying yourself first and taking a portion of your paycheck and setting it aside into savings. And the best method to do that is through your direct deposit if you have that ability. By having the money automatically transferred into your savings account, you never miss it. And just think of that savings account as out of sight, out of mind. And every 3 to 6 months, as you're meeting with your financial expert, taking a look at that savings account and see how you're progressing, so you can start looking at longer term priorities once you meet that immediate emergency reserve savings. But pay yourself first. Once it's in your savings account, just completely forget about it. Some savings strategies. This is one of my favorite parts of this presentation to go over. One of the things that we can all do, even as something as simple as when we go grocery shopping, looking at step down spending strategies. Instead of looking at brand names, which may be more expensive, and in most cases, they are slightly more expensive because we're paying for the name instead of the actual product itself, looking at getting the generic store brands as we're out grocery shopping. If you're looking at clothing, instead of looking at Louis Vuitton or Burberry, looking at a brand that may be a little bit not as high of a brand, but still good quality, is a great way to help continue to make your money last, as well as build your savings. Windfall money. Windfall money is really as you come into money, right? So if you win the lottery, knock on wood, one day we all do. But in the event that you win the lottery or you come into an inheritance, right? What are you going to do with that money? Start thinking of that stuff ahead of time. We all have parents. We all have elderly people in our life that, God bless them, I hope they live forever. But the reality is one day we may have to cross that bridge when you may be coming into some inheritance. Save payments. One of the biggest things I see with my clients, and it's not just with my clients, but even as I'm out talking to friends and family, think of those late charges when you make your monthly payments. Making your payments on time are going to save you anywhere from a couple $100s a month to a couple $1,000s a year. So making your payments on time is one of the easiest things that you can do to help yourself save money. Comparison shop. My son is really into Under Armour. So as we go to the malls and we're looking at school clothes and we're looking at sporting gear and we're looking at shoes, there's a price difference between when you go to the mall compared to when you go to an outlet, right? There's a big price difference between the two. Looking at different brands, looking at different stores to see who's running the sales and who is selling it at full retail price is another good way to save yourself money every single month. Delay purchasing. A good example of this is prior to this pandemic that we're in, prices were pretty stable. And once the pandemic came, towards the late part of April into May, started to see prices drop on luxury goods, cars. The prices of cars, the MSRP prices have started to fall a little bit. The annual percentage rate on loans that you're getting started to fall as we went into May. So sometimes delaying those purchases, waiting for a sale, could also save you every single month or for every purchase that you make. Clipping coupons. Clipping coupons. I grew up in a household of 6 children with my mom and dad. So there was 8 of us total. So clipping coupons on a 1-income family really went a long way and saved my family a couple $100s every single month as we were shopping for a large family. So I know it seems simple, and I know it seems that sometimes it could seem silly, but it's a great way to save yourself on your monthly expenses. You know, and collecting change. Collecting change. I don't typically use cash anymore. I do everything through my debit card or electronic payments, even through Zelle, Venmo, Apple Pay, etc. So I don't carry a lot of cash on me, but when I do, you know, at the end of the day, I'll empty my pockets and put it in a jar and let it grow. It may take a couple years, but at the end of the day, it's still money I'm putting aside to help build my savings for the future. You know, and many banks out there will offer programs where some call it keep the change, some call it ways to save. But at the end of the day, if you spend on your debit card $5.20, your bank would move that 80-cent difference between the $5.20 that you spent to that $6 round number and move it into a savings account for you. You know, a client I worked with about 10 years ago came back in and saw me at the beginning part of May and showed me the success that he had. And he was able to pay for his college just by using that Keep the Change program that we offer. And I know some of our competitors call it a different name, but a lot of our competitors offer the same type of program. But putting that money out of sight, and think of it as out of mind. It's not there until you absolutely need it, and it really can go a long way. You know, another strategy of mine is bringing my lunch. You know, years ago, I started looking at my own expenses. And now that I'm in financial services, I look at it on a regular basis. You know, at one point, I was spending almost $300 a month just going out to eat every day for lunch. You know, it's nice to keep that $300 in my own pocket instead of giving it to somebody else for food, right? So bringing your own lunch can really go a long way as well. Designating 1 week of the month as thrifty week, meaning that you're doing everything you can to minimize your expenses. You know, if you normally go out once a week, staying in that week, making a fun event at home, instead of going to the movies and spending $20 on tickets, maybe rent a movie, either from Redbox or even through your cable provider, where it may only cost you $5 for the entire family to watch a movie. You know, these are all small things that we can do every single day and every single week or once a month just to help continue to build our savings. Utilities. You know, I actually just did this through when the pandemic started, and you know, we have a little more time since our hours are shortened. We went from working 9 to 5, now we're doing 10 to 4. So I have a couple extra hours during the day, you know, and it gave me an opportunity to take a look at my own bills and say, okay, well, why am I spending $250 a month on my car insurance? Let me shop around. Let me see where else I can get a better deal with the same type of coverage. You know, I took a look at my electric bill, you know, and started looking at things in my house and analyzing, why are these lights on? If I'm not in this room using it, you know, I've got to get better at shutting these lights off as I leave. You know, not letting the fans run in the house now that it's getting hotter. You know, my upstairs, the 3rd floor, it gets really hot during the day. So maybe opening a window instead of running a fan all day long could also be another good way to help build or reduce your monthly expenses. You know, one of the things that also stands out to me is ATM withdrawals. You know, we've all been in positions where if you're out, you need $20 or $40, whatever it might be, and the closest ATM is not associated with your bank. You know, keep in mind the bank's ATM that you're using normally is going to charge you a fee up to $3.50, and your own bank is going to charge you a fee or potentially charge you a fee of up to $3.50. You know, so when I think about it, $7 to make a $20 withdrawal isn't really worth it. You know, and I know there are people out there that fear using a debit card as a result of the card being compromised, or hearing of friends and family whose cards have been compromised. But in many cases with your Apple Pay or Samsung Pay or Google Pay, or even with using your debit card, believe it or not, your funds are actually a little more secure because you do have the ability to file a fraud claim in the event that you didn't make that purchase. And you're saving yourself upwards of $7 instead of making that withdrawal, just using an electronic type of payment. So Tara, if we can go on to the next slide. All right, so compound spending or compound interest. You know, this is one of the things, I have a 12-year-old son, and I've recently started going over this concept of how your money can compound, especially with the interest that you're earning. Right, and setting money aside, forgetting about it, and just letting it continuously accrue interest. You know, what you're seeing on the slide now really shows if you start with a $600 that you initially deposit into the account, you know, depending on the interest rate of that savings account, and most savings accounts are pretty liquid and they're pretty variable, so they can change at any time, but let's in this case assume the interest rate is stable and it's staying the same over the next 20 years. You know, if the first year I'm earning $16 of interest, you know, year one with my $600 deposit, I'm going to end with $616. And you can see as you look at year after year, continuously depositing an additional $600 one time a year and just letting it sit there every single year after 20 years. That $600 initial investment you've made and the $600 a year investment you make subsequently after that first year, it's going to equal well over $20,000. So the concept of just letting the money sit there, accrue interest, because that interest now becomes part of the principal and it's now accruing interest, is another great way to help build on your long-term savings. Now, depending on the type of savings vehicle you choose, you know, the example here is giving you a basic savings account, you know, but as you start working with financial experts or financial planners, imagine an interest rate of 1.6%. Actually, that's a little far-fetched in this environment. So let's say a basic savings account is earning 0.03%, and you're talking to a financial expert who can get you a yield of well over 2%, right? So there's a huge difference between that 0.03% interest that you're earning on an annual basis compared to that 2+% that you could be earning through a more complicated financial tool. But that's where it's important that you work with a financial expert and keep in contact and regularly meet at least twice a year with your financial planner to ensure that your money is continuing to work for you and to achieve the goals that you initially set forth. So Tara, if we can go on to the next slide. So savings for the future. You know, as we talked about a little bit earlier in the presentation when we initially started, you know, the first step to savings, and the first reason you would want to do it outside of the emergencies, is to really build your wealth, right? At the end of the day, we're all going to retire. The idea is that we don't want to work until the day that we pass away. You know, so starting early to build your wealth and have the type of retirement you want to is extremely critical and should always be top of mind of why you're saving. As long as you understand why you're saving and that goal is important to you, you're more likely to make that happen. You know, you also want to save for the future to meet emergencies and short-term goals, as we discussed earlier. You know, all too often, especially in this day and age of COVID-19, I can't tell you, as I'm reaching out to clients, more and more people are out of work. You know, you're looking at a 14% unemployment rate right now. You know, thankfully, with the clients that we've worked with, we've been able to set aside some emergency savings. So the crunch wasn't as bad. I mean, it's always bad when somebody is out of work. However, they were able to continue until they've regained their employment. You know, so keep that in mind. That's why you always want to have that emergency savings plan. You know, savings can be set aside to invest at a later date and time. You know, as your balances grow, as you continue to earn interest, those investment vehicles can earn you a much higher rate of return. Now, I would always throw the disclosure out there that investments are riskier than your basic CDs, and they are riskier than your basic savings. However, they also have greater returns, but it is absolutely critical that you work with a financial planner and a financial expert who can go through a risk assessment with you and to make sure what they're recommending is suitable to what your risk appetite is. But at the end of the day, your financial security starts with your savings. And Tara, if you can go on to the next slide. So as a summary, use saving strategies. We talked about the step down spending. We talked about brown bagging and using a thrift week. These are all strategies to help achieve your overall goal of achieving your wealth. Compounding interest. It helps build your wealth. As simple as it may be and as little interest it may look like, as it compounds year after year, that number continues to grow, and it's another small but effective way to build your wealth. And most importantly, you secure your future by saving now. The earlier you start to save, the better position you'll be in when it comes time for you to retire. So Tara, I can't see the chat box, but do we have any questions before we move into the next next portion of the presentation?
So Jeff, let's see, if anybody has any questions, go ahead and ask them now. We'll just give them a minute to ask if they have any. I do want to stop and just say thank you so much. Every time I hear your presentation, I learn so much more, and it's always a good reminder to just keep plugging a little bit away at the savings. And I think that some of those tools, like you had mentioned, the banks allowing you to save the remainder of that dollar is a great practice. And if your bank doesn't do it, you can do it. It's such a great practice. I know my bank doesn't do it, but every week I'll take, if I have a $5.70 as a balance, I'll move it over, right? So I get a nice round number in my bank accounts just to move that over. So many great ways you can do this.
Absolutely. And the one thing that I've heard over the years as a pretty consistent objection to savings is you have to be rich to invest. And that's such a myth. You can invest as little as you can to as much as you want. But at the end of the day, you want to start early. That's what's going to put you in a position to have the best type of retirement you want to have.
Absolutely. And so Jeff, I don't see any questions at this time. We're moving into another portion of our presentation, right? Talking a little bit more about retirement. Is that correct?
Yeah, so we're going to talk about economic mobility and next steps. And, part of economic mobility is your credit, right? And when I think about credit, I mean, there's more than just a credit score, right? But your credit score, your credit report, it's all going to have an impact on not just what you're paying today, but it's going to also have an impact on your retirement, right? So as we look at building healthy credit, there's good components of that. You want to build a good credit score. You want to know how to read a credit report and why you want to read a credit report and constantly review it year after year, because believe it or not, you're going to find things on there that in some cases that shouldn't be there. How to use a credit card responsibly and why you'd want to use a credit card responsibly. These are all great ways to not only build your credit, but when you think about it, Tara, I don't know about you, but I know when I went to buy my house, you meet with a mortgage lender, and the first thing they're going to ask you is, what's your credit score, right? So it's not just to qualify you for the mortgage itself. Your credit score and your credit report is also going to have an impact on how much you're paying for that house in the form of what your interest rate is, right? So the lower the credit score, typically there's a correlation. The lower your credit score, the higher the rate that you're going to pay, which means if you're paying more towards your house, it's less you can put aside for your retirement. So these things really do go hand in hand. So we've already talked about, buying a house, why you want to use credit responsibly, why you want to build your credit, and why credit is so important. But at the end of the day, your credit is going to impact not only your ability to buy a house, but even when you rent a house. Anytime you apply for a loan, that credit report is being pulled. It's being reviewed by a lender or by an underwriter to determine not only your ability to pay, but the risk associated with lending money to you. You know, it's also, your credit is a factor when you finance a car or any other major purchase. Even if you're applying for a credit card through your favorite retail store, your credit's being pulled, and the interest rate that you're paying is going to be determined by your credit report, right? It's not just the score, but also the derogatory comments, the credit used to credit available, which we'll go into in the next few slides. So what a good credit score means? So on the slide in front of us, it really goes through what the average is and what the credit scores look like, right? So credit scores can go anywhere from 300 upwards of 850. You know, overall, Americans have good credit. In 2017, the national average was 700. So 700 is something that you really want to strive for, but at the end of the day, the closer you get to 850, the better you're going to get, or the better pricing you're going to get on any future loans or financing that you request. So that's something to keep in mind. You know, poor credit is anything below 580. Fair is anywhere from 580 to 669. Good credit is 670 to 739. So that's where that average falls into. But again, where you really start to see a difference in the annual percentage rate that you're going to pay is when you have credit scores up, starting at 740 upwards to that 850 range. And this is all based off of your FICO score. You know, so what makes up a credit? What makes up a credit score? Oops, got to get that off my screen. All right, so your credit score, the biggest portion that makes up your credit score, believe it or not, is your payment history. Your on-time payments have a significant factor on your overall credit rating. I cannot stress the importance enough of making your payments on time. Not only is it impacting your credit score, but remember, as we talked in the savings program a little bit earlier, if you don't pay your payments on time, not only is it going to bring your credit score down and you're going to start having derogatory comments. So even once you get caught up, those derogatory comments are going to stay on there for upwards of 7 years, right? So every time you have a 30-day late payment, that one 30-day late payment could be on your credit report for the next 7 years, even though you may be able to get your score back up above 700. Not only is it impacting that derogatory comment and your overall credit score, but you're also paying a late fee, right? Some credit cards, a late fee could be $35. In some cases, when you're looking at auto loans or you're looking at a mortgage payment, it could be a percentage of the loan. It could be a percentage of that outstanding balance for that month. So in some cases, your late fee could be well over $100 to $200. So paying your payment on time is extremely important. You know, the amounts that you owe make up about 30% of your credit score. So the best example I can give to this is, let's say you have a credit card and it's the only source of credit you have, and your credit limit is, we'll use a nice round number and say $5,000. If you have a balance owed on that card of, let's say $2,500, so 50%, right? That credit used to credit available ratio is significantly impacted. That is going to bring your credit score down. You know, the typical idea of your credit card is you don't want to use more than that 30% of your credit available ratio to keep your credit score where it is or to continue to improve it. You know, and tying it back to our savings slide a little bit earlier, you know, there are a lot of type of cards out there. There are cards that give you travel rewards, there are cards that give you Apple rewards, there are cards that will give you cash rewards, right? So personally, I have a cash rewards credit card as one of my cards. And I use this card strictly for my gas purchases and my groceries. That's where I'm going to max out my cash back. But at the end of every month, I'm paying that card off. So regardless whether it's a $2,000 credit limit or a $10,000 credit limit, I'm going to pay it off every single month. I'm just taking it right from my checking account and transferring it over so it's at a zero balance pretty much all the time. But I'm not paying a late fee, and I'm getting upwards of 3% cash back for all the purchases I'm making. So when you tie that into the savings, that 3% can go a long way. So another option to look at as you're looking at building your credit and building your savings, be smart about the type of cards that you apply for and the type of cards that you have. If you have cards right now that aren't giving you type of rewards, I would encourage you, call your credit card company and ask them, what other type of cards do you offer where I can get cash back so I can start building my savings? 15% of your credit score is based off of the length of credit history, right? So if you have no credit whatsoever, it's going to make it a little more challenging to get a card. But as you have that card, you want to keep it, right? You don't want to go crazy and start opening 10, 15 credit cards. The average person has, or the average consumer has upwards of 3 cards, 4 max. But the one card that you open first, keep it. Don't ever close it. That's where the majority of your credit history is coming from. So the minute you close that first credit card that you have, keep in mind initially your credit score is going to take a hit. Your credit score will decrease as a result of closing the card that you've had the longest. That's where I would tell you to partner with that credit card company and make sure that you're maximizing the type of rewards that they offer that best suit what your financial plan is. The types of credit in use will make up about 10% of your credit score, right? So there's different types of credit. You have home loans, you have auto loans, you have credit cards, you have debts that you may have from medical offices, you may have debts from retail credit stores, right? So the types of credit that you have will also impact your credit score, but it's only about a 10% impact, right? And last but not least is new credit. New credit can impact your credit score as much as 10%. So just keep in mind, and as you're looking at credit scores, I would tell you, your credit score is going to vary one month to the next. The average is anywhere from 10 to 20 points, right? Depending on the cards that you're using, the balances that you're carrying, how you're using that credit card, if your payments are made on time. Not only that, but also when your credit card companies are reporting to the credit bureaus can also factor in, your credit score changing one month to the next. So if you make a payment, let's say your credit card company reports to Experian on the 23rd of the month, and your credit card payment is due on the 24th of the month, and you pay it off on the 24th. Initially, you would think that because I paid my card off, it's not going to show that I have a balance. But unfortunately, because I reported a day early or a day earlier than when your payment is due, it will actually report that you have a balance on that card, which will impact your overall credit. All right, so Tara, if you can go on to the next slide. So we already touched on a few of these: paying all your bills on time, checking your credit report, and using credit responsibly. And credit responsibly is, again, you want to try not to carry more than a 30% credit used ratio when you're using your credit cards, right? But again, check your credit report every single year. You can go to freeannualcreditreport.com and check your credit report absolutely free of charge one time a year. Or you can write each of the credit bureaus once a year for a free copy of your credit report, and you'll get a hard copy of it. But go through it. Look for things that don't match up. If it doesn't make sense and you don't feel it belongs there, make sure you write a letter disputing that inquiry or that item that's on your credit report, because that can have an overall impact to your credit score. And Tara, if you can go on to the next slide. Some of the things you want to look for on a credit report is your personal information. Make sure your name, your address, date of birth, employer, all that stuff matches up. If it's not correct, you want to make sure that you get in contact with the credit bureaus to correct that. You're checking over your credit history. What accounts are open, what accounts are closed. Make sure that the payment history has been reported accurately. And you're also checking to make sure that if you didn't apply for a credit card and it's showing on your credit report, that you dispute it, because that will impact your credit report, right? I mean, you typically don't want to apply for more than 2 lines of credit on an annual basis. So that can certainly also have an impact. So if it's something that you didn't do, make sure you dispute it. Public records. If you have a bankruptcy, that's a public record. That will be on your credit report, and it could impact your credit report for up to the next 10 years. The average school of thought is 7 years, but it can actually impact it for up to 10 years. And then credit increase, which we already talked about, is another thing you want to be looking for on your credit report. All right, so Tara, if you can go to the next slide. Some key terms that we're looking at when it comes to your credit report is credit utilization, a hard inquiry, as well as a soft inquiry. So credit utilization, we've talked a little bit about. That is the credit used to your credit available ratio. Again, this has a significant impact on your credit score. You want to try to maintain that 30% ratio. Try not to exceed using 30% of your credit available to your credit used. All right, so there's a difference between a hard inquiry and a soft inquiry. All right, so a hard inquiry is when you apply for a credit card, when you apply for an auto loan, when you apply for any type of credit, when a lender pulls your credit to review your credit score, that is a hard inquiry. In some cases, it'll affect your credit report right away. That minute. Credit cards, it'll affect it right away. For auto loans and home loans, it's a little more forgiving. It'll give you up to 45 days to give you the ability to shop around to find the best price possible before they report to the credit bureau that we pulled your credit to give you a loan. You know, and you also have something called a soft inquiry. So whatever bank you bank with or whatever credit card company you have, just understand your credit report is going to be pulled every single year. So that lender or that bank can look at the best way to explain it is we want to make sure that you're using credit responsibly and the risk associated with extending credit to you. Now, those are a soft inquiry. That will not impact your credit score and it will not affect it in any way. So when the soft inquiry is done, you may not even see it on your credit report and it may not even show. That is a soft inquiry. All right, so let's go on to the next slide. So we've talked a little bit about the do's and don'ts of credit. You know, again, I know these seem very basic, but I cannot stress how important it is that you keep your balances manageable. If your credit cards are maxed out, just understand it is going to bring your credit score down. Pay off as much of each credit that you have extended to you, as much as you can, as often as you can. Regularly check the accounts that you have open on your credit report. Make sure it matches. If it doesn't match, you need to dispute it. Because in most cases, if it can't be proven that it's still open and it's still active, and it doesn't, you can prove that it's not yours, then it will come off your credit report. You know, some don'ts. Don't miss a payment. I cannot stress that enough. Again, tying it back to that savings conversation we just had, when you miss a credit card payment, you're incurring fees. That interest is continuing to accrue, and it's also going to impact your credit report and your credit score. Don't exceed the limit on your card. You know, when you exceed the limit on your card, in many cases, either your card can be shut down, it can be closed if you continuously exceed the limit on your card, but you're also paying a fee for that, in addition to the interest rate you already have set on your card. Don't apply for lots of credit cards in a short period of time. You know, that sends up a lot of red flags to lenders when you're applying for card after card after card multiple times a year. It shows that, hey, you're in a position of financial distress. That's the only explanation that you could possibly want this many credit cards for. And if you're declined for any of the cards, it is going to bring your credit score down. So do not apply for lots of cards in a short period of time. And Tara, if we can go on to the next one. All right, so this is how credit card interest adds up. So if you have minimum payments, let's say you owe a balance on a card, right? If your minimum payment on the card is $65, your payoff time, using the simple calculation of most credit cards, are going to require that your minimum payment be 1% of the card balance. It's going to take you 17 years to pay this card off. And you're going to pay well more than $3,000 in interest on this card, right? So when you look at the overall cost of having this card, it's going to cost you over $6,000. You know, the second term just gives you a little bit of a different scenario. If it's the same credit limit, the same minimum payment calculation, but instead of paying $65, you increase that payment to $100, you can increase the amount of time or decrease the amount of time that it takes to pay off the card from 17 years down to 3 years. And their total cost of that credit would be $3,714 just by simply increasing your payment a minimum of $45. You know, and the last scenario shows if you really went above and beyond, you have the ability to pay $200, which is an additional $145 on top of your minimum payment. You would cut down the minimum time to pay, or the maximum time to pay it off, down to 1 year and 5 months just by doing that. And it would decrease the total cost of the credit down to $3,317 versus that $6,000 limit. So when you're talking about savings, that's a whole lot of money that you can put back in your emergency savings or your retirement plan. So Tara, if you can go on to the next slide. All right, so know what a credit score is. So these are some things I hope you're walking away from today's presentation is know what a credit score is, right? And know that the higher the credit, the better pricing you're gonna get, which is ultimately going to result in more money in your pocket that you can put towards your savings and your retirement. Understand how to build credit. Check your credit reports on an annual basis and use credit responsibly. So with that being said, Tara, do we have any questions?
Hi, Jeff. Thank you so much for that in-depth look on credit, because I think it's such a good reminder for all of us, especially during these times, but even in our normal lives, we're all worrying and dealing with credit options. I did have one question that came in, and this was relating to retirement, but should we have multiple retirement accounts or just one?
Okay, so that's a great question, Tara. I would say, you know, in my experience, if you are still currently employed, your employer is typically going to offer like a 401k plan. And I would encourage you to take advantage of that plan because they typically have a matching portion of that contribution that you're making. Right, so many places it could be as simple as 5%. Some people or some employers can go as high as 15%. It is okay to have more than one retirement plan, especially if you are using a plan from an old employer, right? It's okay. I wouldn't recommend it, but it is okay. And it is okay to roll over your prior employer's retirement savings into your new one. And it's okay, and it's okay to have an IRA set up, right? But ideally, take advantage of the 401k through your employer first. That's where you're gonna get the most bang for your buck. But if you have additional money to put aside towards a retirement plan, absolutely, you can open IRAs. And depending on the age and the contribution limits, you can absolutely contribute to it, right? There's other vehicles that you can use as well. There are things like annuities. But again, this is where you want to work with a financial planner to help guide you in the right direction. But absolutely.
And we can reach out to financial planners in our bank, correct?
Absolutely.
Bank
Absolutely.
is a good place to start. Okay, great.
Yep. Start with your bank. Typically, your bank is going to have a financial planner or a company that they use to put you in contact with a financial professional.
Great. Thank you. Well, that's all we have time for today. Jeff, thank you so much for your time, and thank Bank of America for allowing you to sneak away and give us some of this incredible knowledge. I know that, like I said earlier, I learned so much every single time, and it is so valuable just to get good reminders. So thank you so much, Jeff.
Oh, my pleasure. Thank you so much. I really appreciate you guys having me on today. And I look forward to working with you guys again in the future.
Oh, well, we'll definitely have you back, I'm sure.
Well, thank you so much.
So, absolutely. And to those of you who have tuned in, thank you for your time. I hope that you have found some value out of this. In behalf of the Tools for Life Learning Center, we really appreciate your time, and join us next week. Every Thursday at 2, we'll be here with some new information for you. Thank you, Jeff.
Thank you so much.